Welcome into the Kingsbarn studio, Sebastian. This will be the first podcast here at Kingsbarn, hosted by yours truly, Elijah. The media studio and I wanted to start this to essentially have an idea for finance content that could be related to whether that be institutional professionals, investors, and also bring in different professionals that have worked in finance, economics, commercial real estate, any of those sort of areas to essentially picture an audience that, we would like to format this podcast to. And, essentially that's where we come from. So today I have Sebastian on. Sebastian and I have known each other for a few years. And obviously I just kind of want to get into your background and discuss, a little bit about private credit, maturity walls, dig into AI use from the analyst perspective in, whether that be for finance, for commercial real estate, for economics, and then also building, that towards the DST 1031 space. So talk about, your background, man. Like, tell me where you came from, what you do, and, take it from here. Go for it.
Yeah, of course. So first things first, UNLV, double major in finance and economics, had experiences in, various internships during my time in college within real estate or commercial real estate as an acquisitions analyst. Later went on into, what was after that? Equity research, and then wealth management, local government, and then wow, there's I feel
There's
like
a lot.
there's a lot. I was a pretty busy guy.
That was a lot of
Local
different
government,
areas.
and then back into going back with the same company in investor relations. Now currently in investment banking, but it's been pretty interesting. So,
Yeah, a lot of different career paths.
for sure.
I think like I just have like a question. Like, what made you want to try everything? Was it just the thirst for knowledge, or was it, like the thirst for success? What was it?
Well, it comes down to one, opportunity, and two, like perspective, right?
Mhm.
Actually, you could reverse the two. Perspective is probably the most important because you don't understand from the buyer's perspective, you're looking at margins completely different than if you were from the seller's perspective, right? And so when people talk about buy side, sell side, and then of course the conversations always kind of go towards regulation and whether or not something should be allowed. So I feel like I've gotten a decent amount of knowledge within all four of these spaces to really build a unique perspective that I could bring to the industry. And I feel like that was really what led my path.
Nice.
Primarily.
Sweet. Yeah. I mean, out here in Las Vegas, Nevada, there's a lot of interesting opportunities.
sure.
Like, I feel like the finance space here is sort of, being a finance major myself, like I think it's growing. There's a lot of potentiality to it. I think over a long term, growth path from outside of just the casinos and even just wealth management, like I could see it,
Right.
growing from the investment buyer side, buy side analysis and such. Like, I know we have a couple boutique firms here, but we're also seeing some institutions, come out here, over by like the 215 in Durango, right?
Yeah,
Like all,
yeah.
we see a lot of those, different institutions, opening up their offices here. So I do see a lot of growth, and I think this is sort of an area where you want to capture that growth as far as coming from, someone in their, early 20s or, just jumping into college and you're kind of like looking for what you want to do. Fundamentally, if you're, obviously you can land yourself in LA, New York, Chicago.
Right.
But if you also want to capture, an emerging market, an emerging city, I think Las Vegas has got a lot of, potential for that as well.
For sure.
Especially at UNLV, like they've been growing their finance major.
Yeah.
I mean, incredibly, in, the investment space and, outside of just, your corporate finance stuff with casinos, you're also seeing it grow into the investment and sort of different finance roles as well.
Right.
But yeah, I think, your background is pretty unique in terms of from, someone who's done a lot of different areas. And like, honestly, I mean, people don't even have time for that. Like, you can't find enough hours in the day to do like 4 or 5 different, internships and jobs and analyst positions throughout college. And then also, trying to, afford your own, housing and stuff like that. So there's a lot of time that's allocated towards both. But, I want to jump into a couple areas that I think you'd really want to talk about, which is private credit. Obviously, this is probably one of the hottest topics in finance right now.
Absolutely.
I mean, anytime you look up anything related to the stock market, it's It's software, AI, and then private credit, and sort of like that trio between all of them. To jump in, what private credit is, it refers to loans made by non-bank lenders. These are fueled by investors into various types of companies. So typically middle market is what they've been targeting, providing an alternative to traditional bank financing and public debt markets. And it's actually interesting. Do you know how it kind of like started, right? Like the area where I would say not necessarily started, but where it propelled the most was 2008.
Absolutely.
Right. So Ryan Schwartz, he's an MD over at Creative Planning, their financial planning company. They said that private credit began and is as an alternative lending to larger banks, and then has stood out as an alternative investment strategy. So, the global financial crisis ushered, sort of this heightened regulation for financial services industry. He says the new international regulatory framework, Basel III, meant banks had to comply with higher capital requirements and stricter risk weighting. As a result, the availability of lending narrowed during that time frame.
Right.
So especially for middle market businesses. This is where private credit stepped in to fill the gap, and it has become one of the fastest growing segments of non-bank financial intermediaries. The current private credit valuation is expected to exceed $2 trillion by the end of 2026, which I mean, and then $4 trillion by the end of 2030. What do you think is like what do you think like actually fuels this sort of growth? Where do you see it in 2030?
It's interesting that you brought that up. And of course, we've seen as an economy, we've seen massive growth towards private credit. It's in the headlines, it's been the headlines for the past couple of years. It kind of, I feel like, going to college around that time, you get people who want to go into investment banking, then private equity. And now it's interesting because now you can see voices that are saying, okay, investment banking, then private credit, or straight into private credit, right?
Yeah.
So before I kind of touch on the growth and what's driving that, kind of wanted to touch on, in 1978, like I think it was Michael Milken that touched on this. He was large. He's the voice behind, what are they called? High yield bonds.
Oh yeah,
High
sure.
yield bonds.
Okay.
So,
Yeah.
high yield bonds for companies that couldn't take in bank loans or things like that, right? And so that kind of started the whole empire later known as private equity.
Oh, okay.
Right.
Yeah.
And so later on, of course, private equity was not very reliant, but they started doing LBOs, which in and of itself was extremely lucrative. And later towards 2008, early 2000s, things like that, that's kind of when, as you mentioned, private credit exploded.
Yeah.
Or, became more well known. And so I feel like the question isn't what's driving the growth, because I feel like the demand for credit or capital is always going to be there, from different innovations, from different firms.
Wow.
It's going to expand as much as, the economy's knowledge expands.
Oh, okay.
Right.
Yeah.
And so because there's always going to be innovators, right?
Sure. Yeah.
And I was listening to Howard Marks, the Memo podcast, right? And so I think something he touched on was it's not the lack of demand from firms, right, that drives the growth of private credit, because these firms are always going to want that credit, right? And so I think right now, if we're talking about what we're seeing in the market, we're seeing more advancement in technology. As you mentioned, SaaS, software, things like that. These are all innovations that are highly reliant on capital intensive because of CapEx and things like that. And so with that being said, you're going to need that financing. Of course, these companies being basically venture startups or newly made companies, no founder experience, things like that.
Yeah.
I think that's when you'll start to really see the interest in private credit, or, other types of sources that you won't be able to find from a bank because of regulations.
Sure. Yeah. No, I think that's a really good point. I think, and I mean, seriously, it's SaaS, it's software, it's AI that is driving this. What it's fueled by as well is also insurance companies.
Oh, right.
You have pension funds, you have endowments, sovereign wealth funds. They're regularly investing into, the business development companies. And then, those obviously go into private credit. So, in the same report, Ryan also mentioned investors in private credit may see slightly higher yield premiums.
Yeah.
Right. Which is where this sort of comes into. So you have, like you were saying, this massive need for, on the AI side, on the software side, on the SaaS side, for funding. And then, on the other hand, you have investors that want the adjusted risk premium to that. And so they get that yield. So essentially, again, that's sort of the private credit industry as a whole. But I thought this was, kind of an interesting aspect because, if we're looking at the benefits, right? There's not only, the illiquidity premium, right? Because private credit is just generally very illiquid. There's the diversification. If you're an investor, there's recurring income, there's competitive returns,
right?
You have all of these different things. And then in addition to that, you have a senior secured position. So, many of these loans, they sit at the top of the capital stack, offering collateral backed protection and strong recovery prospects as well.
Right.
But we're seeing floating rate structures with that.
Yeah.
So sort of this, this area here is, the SEC indicates a shift towards allowing retail investors greater access to the private credit markets. I saw this thing the other day that, essentially they might even allow the SEC to have investors put private credit in their 401ks.
Yeah.
So, and this is, the aspect, we'll touch on this in a sec too, related to the systemic, risk there. And you literally look at private credit and everything it's saying, is it systemic? Is it not systemic?
Yeah.
And I think the fact that, from the borrowing side, there's speed, there's flexibility, there's lenient requirements for borrowing from private credit funds, but they're borrowing at, a higher cost of capital.
Right.
These, funds are willing to do that. They're willing to allocate that, that amount of money towards, AI in general, just because they see this potentiality that their earnings could 10x.
Absolutely.
And they will absolutely be able to pay back their debt service as well.
Right.
But do you think it could be, systemic? Right? Do you think there's a systemic risk there?
I think, well, first, let's break down a few things. How do I even get into this? You're right in that, on the investor side, you're looking for a way to protect that premium with that floating rate structure, as you mentioned. You're looking for the upside, getting exposure into private credit because it's a buzzword. It's blown up in the past couple of years, as you mentioned. And so, another thing. Sorry, quoting the Howard Marks the Memo podcast. And it's just, you have innovators and the smartest people get in first. Is essentially what I'm saying. And so by the time that retail investors get in, typically some of these stocks, assets, securities in general are overpriced, or they've already priced in a premium because it's because there's already so much demand for it, right? And it's important to remember that a lot of these firms participating in the private credit market today are these are funds that are taking AUM fees, and you have to question the level of underwriting that they're able to accept.
Sure.
With all the demand that they have to get inside this industry, right? And so, circling back to the original question, like, is this systemic, right?
Yeah.
And so, essentially, I think the best way that it's been said is that it's not. To quote Mark Twain, right? Okay. History does not repeat itself, but it rhymes, right? But it sure does rhyme, or something like that,
okay.
right? And when people talk about the GFC and the similarities to what we're seeing in the market today,
well, that's what they're comparing it to.
No, exactly.
That's what they're going after. They're going after the GFC aspect.
It's interesting because I don't think that we'll see maybe as bad of a correction, but I definitely do think that something is that there could be a slight hiccup.
Yeah.
But with that being said, it comes down to who's really exposed to it.
Sure.
How many, like what really captures the exposure, and that's going to take a lot more research, right? But on top of that, just I don't think that the private credit hiccup, say we'll get rid of the industry at large. I think that it'll innovate, and if anything, it'll be for the better. So.
No, 1,000%. Yeah. No, and I think that's well said. I think the innovation aspect is huge, because even if we do see this sort of correction within the private credit industry, which seems like we will, at the end of the day, there's always an innovation, right? Like the innovation from the GFC was from the bank lending side was private credit.
Exactly.
Right?
Yeah.
Like
You have like the shadow banks kind of
yes.
evolving into private credit,
Yeah.
and you have direct lending.
It's crazy because
Yeah.
you have this area where, again, they're not, it's not regulated as
Yeah.
much as banks and credit unions would be on the lending
Yeah.
aspect. And so if it's not as regulated, then obviously there's an aspect there that people or borrowers can go and look at, you know, the debt funds, and the debt funds see this as an opportunity for flexibility. They can operate under different regulations, under different rules, and they're not monitored as closely, right? Like there's again, this, you know, this sort of Basel III. So the Basel Accords essentially came out over like a long period of time, but Basel III came out because of 2007, 2008. And it added all these extra, you know, requirements for essentially lending institutions to abide by. And so I think that's really, you know, what sparked this sort of direct lending private credit aspect outside of the banks. But I got some statistics here that I think are really interesting. So the IMF, so, you know, looking into the systemic aspect, IMF said in 2025, their financial stability report, they found that 40% of private credit borrowers have negative free cash flow. So up to 25%, up from 25% as well the year before. And then in addition to that, the BIS quarterly reports finds on March 16th that private credit lending to SaaS firms increased from 8 billion to over 500 billion. So I think during this exact same period of time, you see that 40% of private credit borrowers have negative free cash flow. And in addition to that, private credit lending to SaaS firms has increased from 8 billion to 500 billion in 10 years. So, and I'm not saying there's necessarily this direct correlation or, you know, direct causation, but I definitely think there could be a correlation there as well. You know, essentially if these software companies, like you were saying before, you know, you're looking at it from the perspective of, okay, they're going to be making a lot of money later. You know, essentially the growth aspect behind SaaS. So again, the capital intensive nature of, you know, the AI, we could say AI infrastructure as well. Again, private credit banking on the potentiality aspect rather than just the, you know, the aspect behind, okay, is earnings actually materializing, right? JP Morgan found an estimated total AI company issued debt at 1.2 trillion for public and private debt. But obviously we're seeing this growth, right? And it seems to be from the AI perspective, and it seems to be massively attributable to, you know, private credit. I mean, an exuberant amount of money is going into this. And then in terms of, you know, AI build outs, right, we see 28 to 36% annual growth in that. And it's probably even more. That was according to S&P. So bulk of this is fueled by large scale AI superclusters and globally distributed inference capacity. That was a rough one, but basically that means, you know, essentially they run processing closer to data sources. So what this means is like you reduce the delay, but you increase the actual output of data. And so, you know, the AI superclusters and the inference capacities are essentially fueling this AI build out. And you're seeing this on like the hyperscaler level, right? With Microsoft, you're seeing this with, you know, various different large blue chip stocks, you know, that are also doing that. So, but again, they're taking out, you know, a lot of money in at such a high interest rate that private credit does usually, you know, essentially offer. So I think the aspect of it being systemic, right? It seems to be contained within the SaaS AI software industry, if from that perspective. But again, you know, if you have now potentially retail investors putting this in their 401ks, you see, you know, institutional investors again growing their diversification, their portfolio to this. I think, you know, thankfully now there's this sort of skepticism, which may put a little bit of a halt and kind of say, hey, you know, maybe we're going into an area that we don't need to go into from the investor perspective. But the thing is there's an infinite amount of borrowing on that side. So I think the concern would be if borrowing increases technically, you know, theoretically infinitely with regards to the AI push out, then from the investor side, where are they getting the capital from, you know, on for the borrowers? So it seems like the investor side needs to happen. So,
For sure.
what has to happen is some sort of higher regulation, tighter because if you want to go and understand, like you could go and look at the delinquency rates of private credit.
Yeah.
There's core delinquency rates, which, you know, estimates around like 5 to 6%.
Yeah.
But then there's actual estimates that seem to be a little bit higher than that.
Mm-hmm.
And it's such a shadow banking industry. So
Yeah.
how is it that we can, you know, sort of find like any sort of reliable data
I think
right on this? You know,
yeah.
I mean, it just seems so difficult.
Data is the number one bottleneck. I think, you know, when you're as a retail investor or an institutional investor or whatever you might be, I think at the end of the day, it comes down to you're making decisions based off of the data that you have, right?
Yeah.
And so with stocks, it's easy because you have their 10Ks or their 10Qs, and you can tune into their quarterly reports or their annual reports, or I guess since they're gonna they're gonna get rid of the quarterly reports,
Sure.
but you can tune into these reports, and you, as a shareholder, you have access to data because it's readily available to you.
Yeah.
And, you know, whether it's real estate or private credit, I think those are the two industries right now that it's not that these firms are doing. Let me really walk myself through how I phrase this, right?
Yeah.
It's not that, you know, real estate or private credit is doing really good or really bad or lags, you know, in comparison to the market. It's just that the data that we see from real estate or private credit or, you know, even private equity isn't regulated. Like you can't see that. You can't see pricing changes on a regular day-to-day basis.
Yeah.
Right. And so in terms of managing and overseeing your investment as an institution or a retail investor, you know, there's not much that you can do there, right?
Yeah.
Unless you're talking to the asset management or the asset manager yourself. You know? It's like, that's a completely different story.
Sure.
But in terms of what we can do, it goes back to different economic principles, right? Like actually, to kind of relate this to something else, in Europe, this next generation of European cigarette smokers is going to be, or is this next generation of European cigarette smokers is going to be the last one that there ever is.
Really?
Right? I think this current generation is going to be the last,
So,
something like that, right?
okay.
And I'll kind of run you through the history to that, right?
No,
So
I'm curious about the logic behind it.
the logic, and here I'll explain the parallel as well, right?
Yeah.
So the question, or not the question. So here's the context: the law or the whatever's in place now, right? This next generation, if you're born past, let's just say, because I don't know the exact number, if you're born on 2026 and up, the cigarette smoking age requirement goes up every year by 1 forever, right?
Really?
That's to my understanding. That's how I, you know, that's what I read, or that's what I heard.
Oh,
right?
okay.
And so essentially they're saying, like, this is like me and you, if we went to Europe, we could go get cigarettes, you know, not that you would, but it's just,
right. No, I get you.
But this next generation won't be. And so the question that rises from a regulation like that, right, is what's going to happen to the shadow industry of cigarettes, right? Because now you have, you know, in different countries, I can go to the United States of America, and when I'm 21, I can go buy a cigarette. Not to say that, you know, anybody's really fiending for a cigarette, but, but you know, it comes back to, well, this used to be allowed, and this used to be unregulated. This used to be something that I could do, and I can't do it anymore.
Sure.
It doesn't mean that I can't get it anymore, but it means that I'm gonna have to go through a darker alleyway,
right? A different process to get it.
Right. And so
Interesting.
when you ask about regulation, I feel like that's always economists and politicians' like number one question. It's just like, what's really being incentivized here, right? You know, I'm sure, you know, you've sat in economic classes or econ classes. And you hear the downsides and upsides of like rent ceilings or rent floors,
of course,
right?
of course.
And so when you can't get to that equilibrium, and when the government, or, you know, really being careful.
No, you're good.
But you know, when you get that increased regulation, right, the market's not able to perform at that maximized, you know, point.
Yeah,
right?
sure.
And so when you're talking about regulation in private credit, I think more than anything, more than you're going to be regulated to keep this amount or do this, similar to how banks have to keep like their interest reserve, right? Or their not their interest reserve, but they have to keep reserves so that
No, yeah,
exactly,
I
right?
get what you're saying. Yeah,
Yeah.
they have to have a certain reserve requirement.
Exactly.
Right, or
Yeah.
gonna lend out. Yeah.
You know, as opposed to that, I think it'll be, it could, you know, have a similar structure to banking, or it could just be, you know, a more regulated way of reporting.
Sure.
Right. And I think, you know, with real estate or private credit as a whole, I think that could be extremely beneficial to the rest of the market. You know, when you, especially when you're factoring in, you know, for people's 401ks, like this is their livelihood. So
Yeah.
it's insane.
And people need their 401ks, man.
Oh, absolutely.
I mean, I think it's insane how much, you know, the 401k balances have changed by generation. It's
For sure.
absolutely insane. Looking
sure.
at that over a long period of time. But no, I think you made a really good point, right? Like the shadow regulations, and you could look at this with cigarettes. I mean, you could, you know, even vices. You could look at this with like liquor, too, right?
Yeah.
Prohibition era.
Exactly.
Yeah, 1,000%. You know, you see an area that's heavily regulated, yet it's still being used.
Yeah.
And it's
and
now a part
Al
of
Capone,
right. You have a massive criminal enterprise that's then created after that. I think it's fun. It's just one of those areas that's fundamentally like, I mean, like you have a teenage kid that wants to go and like, you know, smoke or do whatever, and he wants to go and enjoy his life, like, and enjoy his life. I think, he wants to go. He wants to go
in hindsight.
In hindsight, yeah,
probably not.
Probably not. But he wants to go and do, and it feels better when. Right, because you're a rebellion. It's just oh my god. There's a different sort of emotion that comes along with the fact that you can't do it. Right,
exactly.
It's like it's a bad thing to do. But I mean, in the same concept with liquor and even cigarettes. But back to the AI infrastructure and stuff. No, I like that segue. I think that was cool. So according to Peter Petrov, he's at Trading Key. He's a U.S. stock analyst. He says that projections suggest a $1.5 trillion funding gap. So it's interesting because you want to say the borrowing side's infinite, right?
Yeah.
And it literally, it seems, I mean, 1.5 trillion feels pretty infinite, right?
It's a lot.
It's a lot of money. Yeah. So, and this is, you know, data centers, we're looking at H100 and B200 GPU clusters, energy. This goes through 2030. Private credit is expected to fill at least 800 billion of that need. So not only are we looking at, you know, 2 trillion now, but then we're also seeing, you know, in which, you know, a substantial portion of that is already allocated towards AI and software. But in addition to that, data centers and GPU clusters, right, like hard infrastructure stuff, private credit is expected to fill 800 billion of that gap, and it's expected to grow 2 trillion. So you're saying, you know, roughly 40 to 45% of private credit in the next 4 years is still expected to go into infrastructure. So, I mean, again, you know, it seems like the biggest exposure, you know, seems to be from not necessarily the aspect of private credit, you know, lending. It seems to be the aspect of what it is lending into. And then looking at that from the perspective. But the thing is private credit is it's notorious. It's known to sort of be, you know, lending that goes into, you know, distressed debt securities, right? Like it's known to invest into those sort of companies, and it's been like that for a very long time. S&P Global says that private credit lending has exceeded broadly syndicated loan issuance for B negative and below rated borrowers for 4 consecutive years.
I read that. Yeah,
it's crazy. So then in the same report, U.S. maturities of B minus and below rated debt will surge to a peak of 215 billion in 2028. Which is up from 56 billion in 2026, 4x difference, and then creating a significant refinancing pressure for leveraged borrowers. And then in addition to that, securitization volumes topped 30 billion in 2025, according to Global Data Center, nearly tripling from just over 10 billion in 2024, with demand currently exceeding supply and sharp growth expected to continue. So from the economics perspective, you're an economics major. You know, the aspect here is you have this massive demand that's needed for AI data centers and GPU clusters, and yet there's very little supply. So, you know, if 45% of that estimated, according to the stock analyst, 45% of that is expected to be private credit for the fund to fill that funding gap. I mean, from the economic side, like what exactly does that even entail for the rest of the lending?
All I have to say, right? Because I'm about to nerd out right now. Okay, listen. Context, right? Context. I recently went on a little rabbit hole going down understanding the blockchain and GPUs.
Sure, yeah.
Actually, GPUs just got recommended. And you know what? That's a whole separate rabbit. So before I touch on anything, right?
Yeah.
Because the original question, like I'm gonna make this like I'm gonna make this my anchor, right? Okay. Is that the original question is you're concerned about the investment or the private credit investment growing and the demand for GPUs increasing while GPU supply actually remains constrained. Is that that's kind of like
the
gist of your question.
I think that's a good area to go to.
Okay. So essentially, right, private credit invests into, actually, we'll start with GPUs.
Okay.
Right? So GPUs and other computer chips, we'll just say chips in general, right? Because GPUs is kind of broad. Yeah. Right. So we'll say chips and go even broader. Right. So we'll just take an average computer chip, and if you took like an average computer chip, say 10 years ago, right, you could probably hold one, in your hand just like this. Yeah. Right. But now in the same hand, you could probably hold, I don't remember the exact amount. I think it's either thousands but you can hold a lot of chips in your hands.
Oh,
right
now. Now.
Right.
Yeah.
And so I guess that really just goes to show that this is the technological advancement that we're seeing in technology and software infrastructure, through actual assets, right? Like through actual products. Yeah. So the interesting thing is these companies that produce, GPUs, computer chips, whatever, right? They extensively work towards doing research to make them even smaller, right? Okay. So if it's, I don't even want to say that it's a million, but I wouldn't be surprised if millions of computer chips could, be held in your hand.
Oh, yeah. I'm assuming it's a substantial amount.
Exactly, right. There's a lot. And so the money driven into this industry is real. I do think that fundamentally is backed. It is sound because you're actively trying to increase the amount of units that you can produce. Yeah. Right. For a cheaper cost. I think I left that out. The research goes into making, as many as you can, for the cheapest amount and as small as you can. So it's really just the classic maximization.
Yeah, absolutely.
It's actually really interesting.
From the economics perspective.
Oh, yeah.
It's classically maximizing. Yeah.
Right. And so when you're looking at the industry as a whole, you mentioned that there might be, constrained supply, and to be honest, I don't think that will be the case. I do think that you'll see that increased demand, and if anything, as demand increases, supply will also increase because the investment into research is either constant or growing, right? And so when you see that private credit is extensively investing into these industries, you're looking at industries that are actually looking to optimize 100% of the time, right? 110% of the time, it feels like, right? And don't quote me on that. That's not an actual statistic.
No, it's okay. Yeah.
Right. But like, that's, it does seem like that is what we're seeing in the market right now. Yeah. And so, when you're looking at this industry as a whole, and what does private credit exposure look like in this industry? What does that mean for the rest of the economy? I don't think that this specific sector, right? Especially with the massive innovation that we're seeing right now, will be our downfall. I think more private credit into other assets, and I'll just kind of leave it at that. Yeah. I think that's where you'll really see the most trouble with exposure. Sure. Right.
Kind of like what I was saying too, is if you, the private credit going into really, essentially, 40% of the companies being negative cash flow. I think that's a pretty astounding statistic. So, but if
I do think that was the original question. Sorry.
No. It was just related to like, the aspect of, essentially a supply, obviously there being a massive supply on the or demand for, essentially there being a $1.5 trillion funding gap, you know, and 40% of essentially that is going to be, you know, funded through private credit, then overall, what does that mean for the rest? Where could the rest of that come in from? But no, I mean, you did go down like a really interesting route. No, but you did go down from a good, you know, to a good rabbit hole, which is, you know, sort of related to like the smaller the chips get, the more powerful they get, the more transistors you can fit on the individual chips themselves. So then it's a better processing power, and it's doubled every single year.
Exactly.
Since I don't want to quote the exact year, but it's doubled every single year from its inception.
Right.
And because the idea is like, you know, the more transistors you can fit on a chip, then essentially the more power it has. Now, obviously there's a cooling factor that needs to be considered, and there's probably a singularity point that it does get to. But as of right now, I mean, it has not stopped.
Oh, yeah.
You know, so these chips get more and more, and they're arguably much more expensive every single time, because you need really high powered pure gases to essentially, you know, to create these chips in the first place, which, you know, goes into an entirely separate area. But needless to say, I think the $1.5 trillion funding gap from AI into 2030, I think the reality is 800 billion. They say 800 billion is going to be secured by private credit.
Yeah.
I definitely think if earnings aren't materializing correctly in the way that people project them to by 2030, I think you're going to see different, you know, extensions. You're going to see, you'll start to see defaults. You'll start to see private credit defaults rise.
Yeah.
That will be the indicator that it's systemic due to AI.
For sure.
However, I also feel like the 800 billion, for some reason, it feels, even though it's 40 to 45%, it feels light. It feels like it could definitely be, you know, more than that. And the reason why I say 800 billion of that need is because, you know, 800 billion of the total 2 trillion that would be going out of private credit. So 45% again, of all of private credit lending is expected to sort of go into that AI area in the next 4 years.
Okay, I see what you're saying, and you'll be able to see if it's systemic or not based on the default rates.
So I think we could say, oh, it's too soon to say. Oh, it's too soon to say. But if you're seeing, you know, if you're seeing delinquencies rise, cash flow isn't income. You know, essentially, it's not materializing on the bottom line. That's the case where I could see, not necessarily it being systemic, but it could definitely be detrimental.
For sure.
And if private credit begins to be held in a lot of 401k accounts, I think that could also be a sort of issue there from the retail investor side, right? Because like, I mean, think about 2008. The whole reason why it was systemic was because it was sort of this, albeit it was a much deeper layered, you know, you had mortgage-backed securities, and then you had collateralized debt obligations, and then you know, you had essentially financial weapons of mass destruction. In this case, I don't think we're to that level. But it's sort of being questioned like that, and as it should be. The problem is it's just not regulated. As well as it should be, you know. But anyways, I think, do you have anything to add to that?
Well, I mean, I do have something to add, actually, because you're right on. Going back to what you originally said.
No, you did,
You know, a lot of these companies that private credit is investing in are negative free cash flow companies. As I mentioned earlier in the podcast, just like early, like venture startup-esque, you know, companies. And when you take companies like NVIDIA or AMD, or let's say if you took ServiceNow, I'm trying to think. If you took ServiceNow or any of its competitors, ServiceNow, I think Datadog, if you took those down to a phase 1, right, and you looked at free cash flow margins growing from, let's say, 2017 to around 2022, 2024, right, you'll see that but free cash flow margins drastically increased because the business model increased, because they were able to innovate so much, right? And so to kind of touch on your point, like, it is a little concerning that private credit is investing so heavily into these negative free cash flow companies. I'm sure that the reasoning is that the innovation in these negative free cash flow companies is going to pay off in the long run, or like at least in the 5 to 10 year forecast, right? And so that drives their valuation today. And so when you're looking at it from the 401k perspective, like, I guess now I do see that reasoning, because at first I was a little bit
No,
I
no,
was
no,
a
no.
little bit
I think
hesitant to touch on this
right.
subject,
Yeah.
because, or at least like when I originally heard the news come out, I think it was like 3 weeks ago, right?
Uh-huh.
When Trump announced that, um, Trump, yeah, Trump kind of touched on the 401ks being allowed to
Yeah.
invest in private
Yeah.
credit and
Yeah, it was like that.
alternative assets.
Yeah, yeah.
I
I
think
think he talked
alternative
about it,
assets as a
and if I'm
whole.
not mistaken, the
Right.
SEC touched on it
Yeah.
mostly. Yeah.
And
Obviously, it's a SEC thing. Yeah.
right, right. But it's interesting to see, because, you know, when you look at 2008, 2007, 2008, the default in mortgages, right,
Hmm.
from landlords, right,
Yeah.
caused evictions
Mm.
of tenants,
Yeah.
right? And so when you're looking at the industry as a whole, it almost seems like retail investors, right?
Yeah.
Or, because houses were traditionally,
Hmm.
most Americans' first investment, or first major investment,
Sure.
right? It does kind of feel like retail investors take on a lot of the burden,
They take on, yeah. Well, if they
like,
have access to that,
right,
right?
right,
At the
right.
end of the day,
And
it's allowing that.
it's exactly, and it's interesting again, because, as I mentioned earlier in the podcast, like, the smartest people get in first,
Yeah.
right? At discounted cost, because the idea or the opportunity hasn't been realized yet.
Yeah.
But once it's become a buzzword, once there's so much demand driven for one opportunity,
Yeah.
that's when you start seeing these premiums,
Mhm.
this price markup for the initial investment,
Mhm.
right? And of course, the retail investor got in last, right? And
Yeah.
so
Yeah.
I just, it is pretty interesting. And the other thing, kind of just to tie it all in,
Mhm. It's okay.
and you know what? It'll come back to me.
It'll come
But
back.
it'll
Yeah,
come
it's
back.
okay.
But
No, take your time.
I do think in the long term, I'm sure the bet is that technology as a whole, or AI, or
Mm.
software, or whatever it is, these
Yeah.
negative free cash flow companies
Yeah.
will see massive innovation that'll drive growth, that'll drive growth in the long
Yeah.
run. And so,
Yeah.
taking these companies, like I mentioned, Datadog, Snowflake, even,
Mhm.
right? But like, back to these
Mhm.
phase one stages,
Sure.
it would be extremely interesting. I know that when I pitched Snowflake a little while ago, that was exactly what I did to kind of drive the valuation.
Sure.
And
Yeah.
so it's an interesting market for sure. We're seeing a little bit of
Yeah.
rockiness,
Yeah.
to
Yeah.
say the least, in software.
And
But
rightfully so.
yeah,
Like rightfully so. It's a questionable area, and it's always
yeah,
it seems like it's always going to be like that. Yeah, I mean, Morgan Stanley found that many software companies were underwritten at, high 2021 era valuations with higher leverage,
yeah,
right? So
yeah.
about 50% of borrowers in the software sector are now rated B- or lower.
Yeah,
So your ability to refinance in 2026, 2027, obviously Morgan Stanley sees this as a concern, in not only them, but I think, anybody who's looking at the software, companies that, again, if you're underwriting at, let's say the 2020 to 2021 interest rates, or we'll say 2021 is more accurate, then yeah, I mean, fundamentally now it's you're looking at like 3 to 4% higher.
yeah,
Right. So, and now it's, then that brings up the concept of, maturity walls, which I think we'll get into. But in addition to that, the payment in kind, which do you know about payment in kind? Okay.
Yeah.
So this is a feature in private credit, right? And this is also another area that is very questionable. That allows borrowers to defer cash interest payments, accruing them to the principal balance instead.
Mhm.
So when I was trying to think of, okay, how can I find out what the stable rate, what's the stability of private credit in general? One of the areas that I thought about was payment in kind, because essentially if you have, and it's also a good indicator to understand the overall economy, the household economy in general, right? If you're a borrower and you can't make, the proper payments, then, the interest goes into the principal,
Right.
that sort of situation. So you're accruing them to the principal balance instead. So if you're the borrower and you're not able to make payments, that's essentially what this whole situation. So if you see a volume increase in this
Right.
type of lending,
Right.
and then while you see that, you also see, this happening specifically within private credit, and this being a feature of which, S&P Global finds that payment in kind usage has risen notably, with 8% of investment coming via payment in kind, once limited to mezz and subordinated debt, and now it's appearing on the senior secured loans. So my question is like, are people seeing payment in kind as less risky, or is it that the volume is increasing drastically enough for them to then see it on the senior level tranches rather than the mezz and in the subordinated debt? That's my question, because the aspect here is like, is there a massive delinquency within payment in kind? Like, how does that, or does that even filter into essentially these the rates then being considered? And it was just sort of a question that I had when I was analyzing it. But the fact is that it has risen notably. The usage as to which has risen notably.
Mhm.
Now, the other question is like, is this something, from the payment in kind perspective, is this something that's, people are just utilizing it just to utilize it, even though they have the funds to be able to take care of these payments? Or is it a matter of they just strictly can't? And so this is another area that you can sort of understand private credit. So if you have a massive amount of borrowers that are no longer going to make these cash interest payments, essentially, are they doing it because why not? They have the ability to, or are they doing it because they really can't?
I see. I think, okay. Super insane question. And the only reason I say that is because you're saying, are the companies simply not able to?
Yeah, no. Well, I'm wondering,
or like they really just can't.
Yeah, I mean, the question is like, are they not making these payments,
Yeah.
On purpose? Because
Yeah.
it's more they can, allocate the cash flow somewhere else.
I see.
Or is that
Okay,
just
okay.
arguably that could be as bad? Or are they
Yeah.
doing it, because they literally cannot,
Yeah.
they need to do payment in kind. I also just think in general, people, companies and consumers are a little bit more comfortable with taking on debt nowadays because they have to.
Yeah.
So I think that could be an aspect there, but I'm wondering if it's strictly because they can't. And this is a question for, for everybody. It's like, is it because they can't, or, is it because they can, but they want to allocate their cash flow somewhere else, which arguably could just be the exact same.
Absolutely. Well, yeah, to first address, I do think that payment in kind increases into senior debt, right? But we'll start there. I think that in and of itself is not an indicator, but is a sign, of struggling companies,
Sure,
right?
yeah.
Because you're seeing, in the capital stack, senior debt, mezz, subordinate, and then you have like any preferred equity, right?
Yeah.
And so, from that, equity shareholders are supposed to get wiped out first.
Yeah.
They go senior, mezz, and then everything else, right? And so when you're
looking at
sorry.
equity, it's equity, then technically preferred, and then mezz, and then everything else, if I'm not mistaken. Or mezz and pref are basically the same, but
mezz and pref, and then like common share.
Common share is at the very bottom.
But where was I going with this? Okay, on the senior debt side, if you're seeing an increase in payment in kind, then it's I can imagine that it would cause some insecurity from loan from I want to say private credit investors, right?
Yeah.
And this it's funny because I wanted to touch on this eventually, and it really goes back to direct lending, right? So direct lending is it's a segment of private credit, right? Because where private credit funds directly loan out to a single company, right? At least to my understanding, right? You're lending out to a single company, right? And that could be senior or mezzanine debt, right?
Yeah.
And so you have firms like Oaktree, right? Who are really how do you say this? Really strict in their investment criteria. They hold less than, I want to say 20%, less, maybe even less than 20% of direct loans in their private credit fund, right? Whereas everything else is just traditional private credit.
Yeah.
Right. But, when you're looking at, as I mentioned before, exposure, it all goes back to exposure. It comes down to, of the exposed companies, right? So like of the, let's say, insurance firms that are invested in private credit opportunities, of those private credit opportunities, what percentage of their portfolio allocation relies on direct lending, right? And then going back to what you said, you
Yeah.
know, on these software companies, right? It's just exposure, exposure, exposure,
Right,
right?
right,
And so
right,
it's like
right.
of these direct lending assets in their portfolios, what percentage of that is in like software, AI,
Yeah,
or
yeah,
something quote unquote risky, right?
yeah, yeah.
And so going back to are these companies are they able to make their debt? Are they able to pay their debt? I
Yeah, yeah.
think the mere fact of just the increase in payment in kind really just answers that in and of itself,
Sure.
right? And
Yeah.
so these companies are probably underwater, right?
Yeah.
Right. Or there's probably something wrong in the revenue or business model, or maybe it's just that the fact that they had this floating rate term from a private credit lender and that debt service is just a little bit too high. Maybe they do
Yeah.
see a little bit more value in deferring it. But I think what it really comes down to, right, not to say that these companies are any less valuable, right?
Yeah.
What the underlying question is, can this software be replaced by the next AI model? Right. And so again, which in and of itself is kind of like a circular cycle type of thing.
Yeah, I
right?
mean,
because you're looking at like
I see
you're investing in
triangles.
software, and it's like exactly.
So
It's
I
like
see-
it all just goes back to the same thing. It's like,
Yeah.
okay, well, I'm gonna give money to this company, and this company is, you know, underwater. It's kind of a venture startup, yada yada yada.
Yeah.
Right. But at the same time, this other company is saying that they might be able to automate and do what this company does.
Yeah.
Right. But you know, this is relying on infrastructure from, I guess, maybe not a triangle, maybe something like a square,
Maybe a
something
square.
like that.
Yeah.
Square, pentagon. I don't know.
It's all very connected.
Right,
Though.
exactly.
Like, fundamentally, if you put it on a graph, it would
Right.
probably show up as a square. or
It all
something.
kind of comes down
Yeah.
to the same aspects, right?
Yeah.
Where it's like, if I invest here
Yeah.
and this segment doesn't do good, what does that mean for the rest of the segment? And, you know, they say the AI software, and then you have technically software infrastructure, you have GPUs, all of this. They say that this is like same or similar in terms of sector, but I wouldn't say so, because that's why you have SaaS, then you have TMT, right?
Sure.
Where SaaS is like a subsegment. Right?
Yeah.
And so,
Yeah.
you know, just going back to that, it's odd, it's weird that, you know, so much relies on one industry.
Yeah.
It's interesting to see that so much, I think it would be interesting to see how much exposure there really is to these companies and direct lending. And so in terms of these companies that are going negative free cash flow, as you mentioned, it's like the question is, can this business model sustain given improvements in AI?
Yeah.
Right? Because you have Anthropic coming out with new models like
Like it's I mean, it's insane. Yeah.
I realize every other week I see some crazy report.
Well,
and it's like,
I mean, like I heard this thing with Sam Altman that he came out the other day, and he mentioned, you know, they're doing some sort of fearmonger marketing. Have you seen that?
I have.
Okay, so Anthropic it talked about this model called Mythos. And
Okay.
Have you heard of
Yeah,
it?
yeah.
Okay, so it's essentially supposed, like, they don't want to release it because of the cybersecurity concerns.
Yeah.
And then Sam Altman comes on, he's like, I mean, why do you have to say that? Like, you know, why do you have to mention the cybersecurity concerns? If it just makes people want it more, because they're like, oh, it's so powerful.
No,
this thing
exactly.
can destabilize an economy with cybersecurity or something crazy.
You know, I do think that there is a lot of exaggeration. Yeah, I'm sure.
Yeah, I think.
But at the same time, like
I mean,
the thought is a little scary.
Well,
for
now,
sure.
I mean, like with Claude and such, it's like going into the direction of, you know, it essentially can make phone calls for you. Like the whole thing with that was also part of their marketing scheme, was this guy needed a plane ticket, and all he did was tell Claude that OpenClaw that, hey, I need a plane ticket, and OpenClaw essentially just literally called the teller, and then got him a plane ticket, sent him the boarding pass the same day. So we're getting to this point again where it's like, okay, AI is pretty powerful. It's got a lot of uses for sure. And, you know, back to, again, like what you were saying, is it, you know, the actual software companies themselves that are going to be able to adapt to AI, or they're going to be overtaken by AI? And that's the whole question there. But the reality is infrastructure vulnerability is medium as far as, because they're backed by the infrastructure, right? So you have, in terms of from the private credit risk perspective, SaaS software risk is high, because you obviously have like the legacy moats. But those are obviously being overtaken by AI.
Right.
Like anytime OpenAI, Anthropic has been able to make an update, I mean, it's known as, you know, literally the AI startup killer.
Yeah.
Right. So Hyperscalers like Microsoft, Google, and Amazon have a little bit lower risk because they're backed by a ton of massive cash flows. So what it seems like is like all of the SaaS companies that are perhaps not doing, the best in terms of, this negative free cash flow are backed by private credit, but we also see private credit that's backing hyperscalers. So the diversity is, okay, well, if private credit can maybe shift their focus away from the negative free cash flow, maybe that will, decrease the illiquidity problems that they're having, and then also jump into the aspect of backing companies with infrastructure and free cash flow, right? Like if you're just backing a SaaS company and they need the money and private credit can supply that. I mean, at the end of the day, all of a sudden you could have invested, a little bit differently into a better, a company that actually does have cash flow, a company that has infrastructure attached to it that can collateralize on the loan, like that sort of situation. But I want to get into something a little bit too that I think has been talked about from last year that I heard about significantly, and I saw it on a LinkedIn post, was essentially all this money's coming due from the financing perspective. So we have this massive maturity wall. And a part of me is so initially I was really nervous about this when I was looking into this topic because I wasn't too sure exactly, what the exact statistics came about. 2025 obviously had a lot of refinancing because, people were taking out, substantial amount of 3, 5, 7-year loans on very, very little money. On very low, low cost money. Essentially, cost capital is it was very, very little. And now these are coming due. So, what I'm seeing here is like from the commercial real estate perspective, we'll touch on that first, and then I think we should go into the maturity walls related to other stuff. So I have this quote here, and this is from, Reed Smith. And Reed Smith basically says that many in the commercial property debt sector have warned of a so-called debt maturity wall, referring to a period when a large volume of commercial and multifamily real estate loans is scheduled to mature and potentially require refinancing. So according to the Mortgage Bankers Association, approximately $875 billion in commercial and multifamily mortgage debt, about 17% of roughly $5 trillion outstanding, is expected to mature in 2026. So this sounds pretty daunting. I mean, that's almost $1 trillion worth of debt. The aspect there obviously being, can they refinance at, higher rates, right? And from the commercial real estate perspective, it's one of those concepts that we need to look to history on.
Oh, for sure.
And actually, we don't have to look that far. Essentially, the same.
Look at 2022.
Right. No, yeah, exactly. I was going to say 2022, 2023, even 2025. They actually had $857 billion that was due. So basically about 9% higher. Than now. And essentially, the maturities have declined a little bit year over year, suggesting the overall maturity wave may be easing somewhat, though substantially refinancing needs remain. The problem that essentially people see with the maturity issue is, there's a significant portion of this debt includes kicked cans alone, which is, from 2024 to 2025. They were given 12 months extensions, which are now hitting a higher for longer, obviously, rate environment. Now there's the equity gap aspect, with property values in sectors like office still struggling, roughly down like 15 to 20% from peaks. Many borrowers face an equity shortfall where the new loan amount is significantly lower than the maturing balance. The problem, according to Andrew Robinson, who's an associate at Reed Smith, a large share of commercial real estate loans originated in 2010s and early 2020s, many with typical 5 to 10 year terms with lower rates, are now coming due in a tighter lending environment characterized by higher interest rates. So the question is essentially, how well is the commercial real estate environment now in terms of like if we're seeing lower cap rates from the perspective of, okay, higher valuations on the properties gives us a little bit more wiggle room. And then the other aspect too on the refinancing side is, okay, we're refinancing at higher rates now, which is expected. I think, here's the thing about real estate. Real estate kind of goes through obviously cycles like the economy, but you can see them coming a little while out. So I think, if you are a smart real estate investor and you have a property you got to refinance on, the maturity is coming due, you've used up all your extensions, you paid all your extension fees, et cetera, and it's coming due. You, essentially looking at that from, a longer perspective, a couple months out may save you a little bit of money in the long run.
For sure.
Being able to then analyze whether this is a refinancing play, or if you're going to try and sell it. The problem is if you try and sell it and it's at a higher cap rate than the one, when you bought it, essentially you're looking at a lower valuation.
I mean, I'm sure you'll touch on this later, but that really, hold on, chair's so high.
I know that. Yeah, no, these are high chairs.
Yeah, but you'll probably touch on this later, but I think that's when you have creative structures, right, that really help out in the real estate investment process. And, but to kind of answer your question, like, so I hope you don't mind. I'm gonna break this down, right?
No, go for it. Yeah.
Let's take the cap rate structure. Like, let's just understand like how valuations are impacted by cap rates and what we're seeing by higher and lower cap rates, right? And so, typically for whatever crazy example, let's say that you have a $1 million NOI property, 10% cap rate. What is that? That's around 10 million, right? 10 million in value, right? And say that same year, you enter a higher for longer environment. Let's say that interest rates bump up, or for whatever reason, you are maybe it's a mix of interest rates are bumping up and vacancy has increased in the area or in the specific sector, right, of real estate. So we'll just take office, for example, right?
Yeah.
Let's just say that for whatever reason, and none of this is really like, this isn't based off of anything, right?
Yeah.
Say that
you're just
that
using
same,
this as an example.
yeah,
I get you.
right?
Yeah.
Say that you perform at that same building, right? You got that valuation of $10 million. You took a loan against it, and say that you wanted 60% LTV. You're at $6 million loan, right?
Yeah.
So now, in that same, let's say around that same time, you still have $1 million of NOI for whatever reason, right?
Sure.
Your loan's about to amortize. It's about to come due, right?
Yeah.
And so that balloon payment is coming,
Yeah,
right?
yeah.
And so, what's it? And so, as you're doing this, you enter that higher interest rate environment. You're in office, and now cap rates have expanded just a little bit. So let's say that now you're at a 12.5% cap rate in that area.
I mean,
that
same insane cap rate.
Insane. Well, 10% was a little wild.
No, I know. I mean, starting off at 10, I was like, woo.
Right.
No, I mean, hey, maybe, there could be some areas like that.
Right. Exactly. You know what?
No,
in office.
I know in office.
Maybe.
Right? No, maybe. But
right.
I for the sake of the conversation,
Yeah. And so now that the value of your property has decreased substantially, now you're at 7.5 million as opposed to the original 10 million. What does that mean for your loan to value? You're not at 60% anymore. You're somewhere around like 90, 92, 93%.
1,000%.
Right. And so with that becomes your loan, your loan convents, right? Like if you are at this amount, it's your, I can't think about that.
Like the loan covenants, your
the
DSCR.
loan covenants. Yeah, exactly.
Yeah,
that influences your debt service coverage ratio.
Right.
Right.
Yeah.
And so that influences your valuation. That influences how much equity you're actually able to juice out of the property.
Yeah.
Right.
Yeah.
And so the question being, for real estate, what are we seeing right now? I think the higher for longer environment sucks. Like, period.
Yeah,
I mean, for real estate investors, I do understand, just as an economics major, I understand what we're doing, it's just, but it's, when you're looking at real estate, that it does get a little tricky. You don't want to exit a property when you're in that higher for longer interest rate environment, and as you mentioned before, you're looking at environments where these properties were financed during 2020 or 2019, right? 2021. Well, maybe not 2021, right? I think towards the later end of 2021, early 2022.
I think whenever there was like an environment where cap rates were, because arguably if you invested into like a little bit of a higher cap rate, right?
Yeah.
Like a slightly higher one.
There was a
not too much to the point where it can screw you over, but to the point where it's a little bit higher, and then you obviously exit at a lower one, right? That's like the simple math behind it, and you exit at a lower one with a higher valuation.
Exactly.
But yeah, no, continue.
Yeah, no, it's interesting to see. Obviously, you don't want to see that happen for your properties, as you mentioned. And so when you're looking at the original question being like, okay, where is real estate right now? I think it really just depends on the segment and what instrument you're using to invest, right? And in some cases you'll
What do you mean by instrument? Like,
well, I mean, there's different structures.
Oh, okay.
So,
Yeah.
And
Gotcha.
you could have that fund structure. Maybe you're syndicating. Maybe you're doing like a joint venture, right?
Yeah.
50-50, you and your partners or something like that.
Gotcha.
Right. But it really comes down to what you want as an investor. If you want stabilized cash flow, and like I hate to say it, but like real estate is really like one of the best plays there is,
Oh, for sure.
because
Yeah.
especially if you're in a strong market, if there's strong fundamentals behind it,
Yeah.
real estate valuations, whatever they may be, however they may be influenced, right? If you're looking for strong cash flow on a year over year basis, that's probably where you're going to get it. And that's where that innovation for structures that you use to invest really comes in handy, right? And so, also it presents a new opportunity where if you are selling that asset, right, say at a lower valuation, you might be able to, you might be able to, if it was something that fit your investment criteria,
Yeah.
to sell to a DST,
Yeah.
to get that, to maintain that cash flow, right? You still might be able to, it really depends. I won't, touch on specific
you're okay.
structures,
Yeah.
or you could 1031 exchange, right? There's so
Right.
many different options that you could kind of go into. But real estate as a whole, do I expect
The maturity.
do I expect maturities and the maturity wall to influence what will happen? Absolutely. I think that it really just depends how much of private credit is invested in real estate.
That's a good question,
right?
too.
Because
it's a very good question.
Let's say, what was it, 45% in software and technology?
Yeah.
If that other 55% is in real estate, it's like, that's going to be kind of rough.
So from now to 2028, it's expected to see pretty much about 40% of all private credit to be invested into AI. So right, like what you were saying.
Yeah.
Now, I mean, that's the other question is like, okay, now we're seeing, this influx of maturities, right, into and perhaps even we see a decrease in property values or something related to that area. Then if private credit's also heavily invested in commercial real estate, whether that be through some sort of short-term bridge,
right,
or some sort of some type of investment that way or lending that way, then you also have exposure to that aspect. But it's interesting because the maturity wall that you were saying, like essentially in using your example, obviously the refinancing risk of the higher interest rate environment. The aspect is like real estate's actually been very, very resilient.
Absolutely.
For 2025,
Right.
as opposed for 2025 terms, where you see essentially 2025 proved to be a little bit more of a transition period than a collapse. While 957 billion in scheduled maturities was nearly triple the 20-year average, the market did not experience a massive default wave like a lot of people actually assumed it would.
Yeah.
Instead, borrowers refinance into new facilities, albeit at a higher rate, right? Yeah, of course, across multifamily and industrial.
Right.
Now, I think when there's a massive need for lenders to deploy capital, they have a lot of dry powder on the side.
Yeah.
And they're essentially able to utilize that into, commercial real estate assets. Obviously, there's this ability for them to be flexible with, the rate with, if it's SOFR 450 compared to SOFR 300, depending on, what, are there periods of interest only. I think as a real estate investor, there's a good chance that you'd be able to, refinance at a higher rate, given these negotiable terms and all this dry powder that these commercial real estate lenders may have on the side, this deployed capital that they're able to, allocate towards your property. Office market, however, did take a hit from the 2025 maturity wall.
Oh, for sure.
Many maturities resulted in loans being transferred to special services and undergoing formal workouts as well. I don't really know too much about the 2026 as far as for office. I am kind of curious, but as far as from what I can like analyze is it does seem to be, if we had, obviously in 2025, many maturities are coming due and people were able to be, very resilient to these. At the end of the day, in terms of people and, real estate investors and real estate private equity funds were able to be really, resilient to these and, extend, I think the aspect there, thinking about it from the perspective of like, long-term valuation, the long-term cash flow, does it affect your bottom line? Sure, of course, it's debt service. But fundamentally, real estate has always been a very stable cash flow environment that you've been able to invest into. So if you continue growing your rents at 3%, you can increase your margins over time. If you just refinance and, you're refinancing into, a specific loan facility that might be a little bit longer. And then again, like, having the ability, for consumers in general, even outside of commercial real estate, to be able to refinance in a lower rate environment, obviously being advantageous as well. And that kind of leads us into other maturity walls. So according to S&P Global, global corporate maturities are expected to jump from roughly 2 trillion to 2024 to a peak over 3 trillion by 2028. In the same article by S&P Global, the speculative grade non-financial debt is indeed significant as it is expected to, or as it's set to triple from 309 billion in 2026 to 342 billion in 2028. So we're seeing corporate maturities are expected to jump pretty much by 50% from 24 to 28. And then we're seeing non-financial debt is expected to triple in 2028. And then in addition to that, higher rated companies that refinanced early in 2025, the lowest rated issuers, triple C and below, have struggled to find takers according to S&P Global. In 2026, the amount of triple C rated debt maturing is double the amount of B rated debt, signaling a survival of the fittest environment of distressed companies. Evidently, telecommunications, media, and high tech represent nearly 50% of the debt rated B minus or lower maturing through 2026. So we're seeing more maturities coming about in general from the corporate perspective. And then B, we're seeing very low rated B minus and lower rated coming due at a much higher rate. And these are seen in telecommunications, media, and high tech companies. I think this is, again, going back to our square. This goes back to the aspect of it's not even just the fact that there's a massive influx of subordinated debt that's being issued, but there's also a massive maturity of subordinated debt that's being issued between now and 2028 and 2030.
So I think the perma bears, or the the bears in the market, I think, obviously the bears in the market will see that as, okay, there's huge maturities. We're lending to negative free cash flow companies. Valuations are going to squeeze in this higher for longer environment, yada, yada. Right. But I think there's opportunities in chaos. Right? I forgot who said that. I wish I could quote somebody, because that would have been so cool.
No, that
Anyways, right.
There are opportunities.
There's opportunities in chaos, and the right people will take advantage. Right. And so what I see as an opportunity, just looking from, future investment banker lens, right? It's like, you're seeing what's available, right? And what I see is that if valuations are squeezing, all these companies still have available infrastructure for developing companies. So M&A activity will inevitably, or will respond by M&A activity in response will increase, right? At the same time, you'll also see, of course, I'm sure you'll see an increase in restructuring activity, right? Whether that be Chapter 11, bankruptcy, or out of court settlements and things like that. More of the extend and amend agreements, things like that, as we previously touched on, right? And to say that, oh, this is the GFC would be, it's interesting, right? It's definitely a thought. Or we could take what we learned from the last GFC, right? And so, or we could take what we learned from from years past, right? And so what we saw was when Lehman Brothers collapsed, Barclays acquired, right? And so now Barclays is one of the top banks out there,
bulge bracket banks,
exactly, right?
For sure.
And so it's just
there's an opportunity.
There's an opportunity for sure. So I mean, I wouldn't say that this is going to be the end of times. This is going to be the one thing that really wipes out retail investors or institutional investors. I think that not to sound like how do you say this, too vague, but if you are doing the due diligence, you're doing the research, and you're conducting, you're doing what you can with what you have. I think that you should be able to find opportunities and growth either from the company perspective or the investor perspective. And I think that's going to be a really interesting environment to be in. Real estate, of course, is going to be a really interesting one as well.
I think there's a certain level of opportunity that is always there's I don't want to say it's a famous quote, but there is like a saying out there that a lot of incredible businesses are created during times of recessions.
Exactly.
And it's interesting because you have sort of a twofold, right? In a recession, you generally it's this situation of after a period of time, typically interest rates drop, the cost of capital drops.
Yeah.
And then that allows, borrowers to begin, and then also everything is, arguably very expensive.
Yeah.
Or it's just, times are slowing and they're not, essentially they, say you're an individual and it was this massive financial crisis that went
Yeah.
on. You lost your job, you lost your home, you literally you're down bad.
Yeah.
But you're able to.
Literally, you're down.
No,
bad.
you
Yeah.
are. You literally are down bad. But
Yeah.
you're able to take what you know
Right.
and take the people that you know and be able to think of different ways that you're able to survive. And evidently, a lot of the times, like these people are able to create their own small businesses and build from there.
Yeah.
And it forces them to do that. Whereas generally, if you're in like a time of greatness and such, it's like
Right.
there's always the opportunity to invest because you have a lot of fallback and cushion.
Right.
But arguably, you could say there's a lack of conviction there,
For sure.
as opposed to someone who's stuck in the situation to really
Yeah.
like Lehman Brothers and Barclays.
Yeah.
Like
Yeah.
Barclays saw this as an opportunity to be able to do what they needed to do and secure
Absolutely.
that. Very, very good representation there. I think that's. I think there was again,
Yeah.
I think there are opportunities in chaos. I feel like that could be like the name of this
that's
the name of this this podcast, man.
Absolutely.
So the last thing I wanted to jump into as well is something we do a lot here at Kingsbarn. It's a part of our core business model.
Yeah.
Is DST structuring, right? So a Delaware
Right.
statutory trust obviously is a
Yeah.
legal entity formed under Delaware law to hold title to real estate assets. This allows multiple investors to own fractional beneficial interests in the property without direct ownership.
Right.
While trusts have existed for centuries, which
Yeah.
I think is interesting. The modern DST is a product of a specific legislation, which is the Delaware Statutory Trust Act of 1988. The intent of this was Delaware sought to create a more flexible alternative to common law trusts. They wanted a business entity that offered the same liability protections as a corporation or LLC, but allowed for freedom of contract, meaning the trust agreement could be tailored specifically to the needs of the deal. The legal shield, obviously, around this was the act ensured that the trust's assets were protected from the personal creditors of the investors. And conversely, investors were protected to the trust liability from the trust liabilities. Investors in return for their investment essentially, into a DST, like an IPO for a building, right?
Yeah.
Receive a beneficial interest in which the IRS treats as like-kind property for purposes of a 1031 exchange, enabling potential deferral of capital gains. Relating this to what we do at Kingsbarn, right? Which the DST is typically managed by a sponsor.
Yeah.
We would be the sponsor who handles property acquisition, financing, management, and eventual sale, while investors remain completely passive. As far as the ownership structure, investors own shares of the trust, not the property itself, creating legal separation between the trust and its beneficiaries. In addition to that, the sponsor also performs management. The DST the DST sponsor oversees leasing, tenant relations, capital improvements, and cash flow distribution. Many DSTs usually use like a master lease to structure this, so that way it doesn't violate the 7 deadly sins. Obviously,
Yeah.
I think it's the seven deadly sins, if I'm not mistaken, of a DST. However, these are generally illiquid. Typically holding periods for 5 to 7 years, but there's an actual interesting aspect to this where there's a secondary market being created. Have you heard of this?
Yes.
Okay, so it's one of those areas, and you'll be able to. It's great because you'll be able to talk on this. Is like it's one of those concepts where, it's finance. It's what's the word? It's essentially, it's financial engineering at its finest.
Oh, for sure.
Because you have a marketplace already for the DSTs that obviously hasn't been around for very long.
Yeah.
And it's still fairly new. It's still a fairly, growing segment. But investors took it upon themselves, essentially to fuel the secondary market, albeit it's slim and it's probably I think it's only about 200 to 300 million, in total, size, which is very, very small. And it's probably very, the spreads on that I can imagine are pretty crazy, the bid to ask.
For sure.
However, there is a market being created, which I think is pretty fascinating, typically because these holding periods are 5 to 7 years.
Yeah.
Obviously, investors should be prepared to hold their investment for that full term. However, there is a secondary market that's being created. And I do think the bigger that the DST market grows, and I believe it's 10 to 11 billion, if I'm not mistaken now, or expected to grow to that level, the bigger that grows, the larger the secondary market in turn grows, creating this brand new aspect
Oh, for sure.
of a completely separate marketplace where people are able to buy and sell DSTs. I mean, this is literally like it feels like we're in the midst of a new, market creation.
For sure. And it's interesting that you brought that up. Because when I was, I've done some research on the secondaries market. Obviously, it's an industry for sure. It's interesting. I'll say that. It's interesting because, you get to see what sentiment is.
Sure.
Realistically,
Yeah.
right? It's like, if you want to get out of a position, you're selling to somebody else who wants into the position. I'm more interested in who wants into that position, at that either discounted figure or whatever. And why is it, right?
Yeah.
And it's interesting because in my research, I found that banks are actually increasing that secondaries interest, right? Where they're interested in holding secondaries or having secondary interests, or, or advising on the sale of secondary interests. But, there's an interest from banks into the secondaries market as a whole.
Yeah.
Right. And so I think that's a really interesting thing to see. I think it's interesting to see how it'll grow in the next couple of years, especially with the DST structure. I'm really interested in the DSTs and how we're going to be able to see the growth of the DST market specifically in the next couple of years, especially with the private credit things going on.
Sure.
I think, or with the private credit market right now.
Right. Yeah.
It's going to be extremely interesting to watch.
Yeah.
So,
I think so too. I think it's I think there's an area that, obviously, needs to be discussed. Obviously, like you mentioned, the growth, the DST fundraising reaches 2.4 billion in quarter 1 of 2026, up 34% year over year from 1.82 billion raised in quarter 1 of 2025. According to data from Mountain Dell Consulting, 10 billion to 11 billion in equity raises are expected for 2026.
Oh, wow.
And the last thing I want to touch on too is essentially the investor side of this. So, you have, if I'm looking to invest into, a DST structure, own beneficial interests in commercial real estate, there's obviously been a massive surge. So why is that? Well, if I'm an investor again that's looking for this, I'm and I'm in my 70s, I'm in my 80s or whatever it is, or I'm looking at different ways to avoid a massive tax bill in a very short period of time as well. As soon as I sell my home or sell some like-kind real estate, 1031 exchange into this. From the investor side, it's passive. Right. So the sponsor takes care of the management aspect of that. Zero effort essentially from the investor. You can close in 3 to 5 days, which is incredibly quick. And that's the aspect there that what I was saying related to, essentially you have, a certain number of days to identify and then a certain number of days to close on that asset. However, you can close it in as little as literally 3 to 5 days and avoid that tax bill. In addition to that, it's non-recourse. There's nothing that can, come after you. And then these are typically Class A properties. Again, there's low liquidity, in those. So that sort of breeds that secondary DST market. Obviously if you do the secondary market, there's, the taxable liability aspect there. However, it is, obviously an option, albeit slim. It is an option. But from my investment perspective, I'm thinking, from the diversifying aspect, if, I have substantial amount in my Roth or my 401k, and I do end up selling my home for X amount of reasons. If you want to get out of a specific state, you want to go and, enjoy a mobile home life, there's obviously the aspect of different types of investments. And I mean, I think that's, that goes back into the private credit 401k aspect is, despite there being a lot of negative, sentiment behind private credit, I still think the aspect there is diversification. And we learned this obviously in business school is, to a certain extent, diversification usually assists obviously with risk. And it offsets the risk to sort of find that equilibrium with the potential reward that you'd like. And you offset that by, sort of with coupons essentially and dividends. And you can offset that by those sort of diversifying assets to achieve that required rate of return that you want as the investor.
Exactly. I think, we talked about the bad side of valuations.
Yeah.
But, concurrently, right, for those long-term investors, right, and
Yeah.
I'm talking 15, 20-year holders, right, that have
Yeah.
seen massive property increase and that are looking to exit or
Yeah.
looking to find some way to sell the house, sell the multifamily, or do something with their property, right, because they want
Yeah.
out, but they don't want to deal with the taxable liability, of course. I think DSTs are a great way to do that. And so
Yeah.
it's exciting to see. I'm excited to see how it'll grow, and
Sweet, man.
it's gonna be solid.
Yeah, it will be solid. I'm excited to see how it looks. Well, this has been
Yeah.
a pleasure talking about, some of the really interesting aspects of private credit, maturity walls. I wanted to jump in, to the AI analyst side as well. I think we might be able to save that for next time as well. But,
Yeah.
From the perspective of private credit, I think there was a lot of really good discourse that happened there. I think, it's important to try and, again, and then stay up to date as much as you can on the status of private credit over a long, over the next like 4 quarters, I think is a really good indicator. Especially looking at what the Fed's going to do with the interest rates. Obviously, if there's a war going on right now, we're going to probably see inflation probably spike up in the next couple of quarters because of that.
Yeah.
So I can't imagine the interest rates getting cut. But I am hopeful,
Absolutely.
as like anybody else. But it's been a pleasure, Sebastian. Thank you so much for coming in, man.
Thanks for having me.
Yeah,
Oh my
absolutely.
God.
It's been a great first podcast. Really happy to finish this off with, a great, discourse that we
Absolutely.
had on the DST side. I think it's a very, very important aspect as it is a core structure of ours here at Kingsbarn. But yeah, thank you again.
Thank you
Appreciate
for
it.
having me, Jano. Thanks so
absolutely.
much.